Welcome back to Business AM. Remember, you can get involved 2146. That's your SMS line at Metropole TVKE across all your social media platforms. This morning, we want to tell you the biggest economic headlines that you're waking up to this morning, even as you and your business try to wallow within the effects of the COVID-19 pandemic. All right, at Metropole TVKE, again, across all your social media platforms, hashtag Business AM. This morning, we are gladly joined by Agwanga Omega and George Manga. All right, now fuel and beer are supposed to jump in prices as of list 31 products, including fuel, bottled water, juice, and beer, will experience an increase in taxes in October as the taxman avoided the need to seek Treasury and Parliament approval in January for the increment. Now, this will come as bad news for consumers already heavily affected by the pandemic, as the prices will be adjusted upwards by 5.43%. Now, under the current law, the KRA Commissioner General only needs to issue a legal notice stating the adjustment for new tax to become effective. KRA indicates that they will seek the approvals in the next round of review next year. All right. Now, question being this morning, does the latest review go in line with the president's plan to cushion the economy from the effects of the COVID-19 pandemic? Just before we answer that question, I want us to take a look at how VAT has been performing in the Kenyan economy all the way from 2017 to where we are right now. I don't know whether we have that data on screen. If we can show it, fantastic. You can actually see from 2018 to 2019 where we were, all the way up to where we're right now. That is on VAT on domestic goods and services, which has been quite on an incremental phase, which is telling you that from 2017 all the way to 2019, 2020 to where we're right now, VAT has been always on in incremental phase. All right, let me get you, Manga, on that area now. Do you think that this goes in line with what the country is going on right now when everybody's saying, let's cushion the economy from the effects of the COVID-19 pandemic?
Thank you, Elijah. My take on this is, remember when we were discussing the budget figures in June? In fact, I'm glad we were with Omuga in that setting. That this budget was not realistic. It was not going to address the issues that we had at hand in 2021. And probably some of these things are coming to pass right now. That there were a raft of measures that the minister proposed. And some of these measures that the government is not going to collect their taxes in some of the tax lines. Remember, we had a budget of 2.79 trillion. It had projected that they were going to collect around 1.6 trillion, 1.1 trillion between 2020 and 2021. But remember, in Economic Stimulus Program 1, that is ESP1, the government decided to reduce VAT from 16 to 14%, corporate taxes from 30 to 25%, and they also reduced pay-as-you-earn by a percentile, depending on the quartile where individual is. And some of these things are coming to, the chicken are coming home to roost now, because you realize that VAT and pay-as-you-earn has been the country's major tax revenue lines that KRA has been relying on. But with reduction in those tax lines, meaning the government is now facing shortfalls in those collections. In fact, KRA is projecting that they'll miss their collection targets by around 283 billion shillings come end of this financial year, which is quite a heavy variance from what they had projected. And therefore, I think the minister is just trying to focus and see how they can minimize some of this budget holes. And also, Remember, with the deduction of corporate taxes from 30 to 25%, most organizations, if you look at the most currently, most organizations are reporting either a profit decline or they're giving profit warnings already. That gives you an indication that they're not going to pay their corporate taxes when they close their financial year. So, in a nutshell, this year is going to be a bit tough for Treasury and for the taxman, and they have to come up with measures to bridge those gaps. I'm not sure if increasing those tax increasing taxes in those tax lines is going to mitigate the effect that we have. But the government is on a catch-22. On one hand, they want, but on the other hand, serious shortfalls. So I think it will be a balancing act between collections and the social good of the population, if they are to manage this economy between now and probably the fourth quarter of this year and the first quarter of next year.
Yes, just before I bring in Ogwango Muga to pretty much paint a picture of whether KRA is trying to salvage a year that is already wiped off by the COVID-19 pandemic, I want to stick with you, George. What do you think KRA chances lie in terms of collections? Just the other day, we was getting the headlines that they have already identified 259 rich individuals who have not been paying their taxes. Do you think that that is where the chances lie, as opposed to going to VAT, which is being quite hit, as you say?
I think KRA must be innovative, able to collect. There are KRA focus, that is focus high network base and the tax bracket 2 is a taxing digital economy. That is an area that they are mooted or they are proposed in the budget figures, but we've not seen to go operation like that area. Remember, most of our transactions have gone digital, and therefore that is where the money is. If KRA can find a means of taxing this space, then I believe they can be able to narrow that to 83 billion gap. The third area is trying to broaden their tax base. Remember, in Kenya, the persons who pay their taxes account for less than 10% of the entire population, and therefore, if KRA can broaden their tax base, then I think they can be able to bridge that variance that they already have.
Pretty much. All right, now, Ogwang, I just want to jump to you, therefore. I mean, this law, we were pretty much expecting that it would take effect now, and especially now, where everybody is crying of the effects of the COVID-19 pandemic. But looks like KRA were given that chance, and the commissioner, to pretty much call the shots in terms of adjusting the VAT on these specific products. Do you think that was just a leeway for them to try and salvage something of a year that has been wiped off by the COVID-19 pandemic?
Thank you very much, Simba. KRA is at catch-22, and KRA is well within their mandate. The problem is, whenever we are trying to understand the way they are executing mandate in line with the state of affairs as at now, that is where we have a problem. But the challenge is they are well within their mandate. They are well executing what is called actually their questions of law. The questions fall squarely before them. There is something that George has mentioned that I wish to take on a slightly different tangent. For law to be operational, for actually a tax to be operational, a tax needs to be passed. As at now, we might need 1 or 2 years even to come into alive to the digital economy and the being set up. In as much as the ambit of deciding what will people pay is squarely within the KRA, the proposal or that regime, what is called actually come from Parliament. The point here is, can we, mathematics, now people are transacting largely online, right? But I cannot tax what those people are doing. Of taxing indirectly, taxing whatever is happening online is to a VAT basis, so that if we can review the basic, that if it doesn't matter whatever you're selling, if you the cost of mobility, then if I can just tax you 5.3%, then that means I've been directly taxed. What? So that is one of those ways, and it's actually what KRA really needs to figure out, that can we innovative, as George has said, and in that innovation, they have to meet their bottom line, they have to meet their target. End of the day, Simba, they must show cause why they are being paid. Most of us, we are always mistaking GDP to be the overall economy of the country. As government is concerned, GDP does not actually translate to the earning of the regular. We might have a very functional and a very thriving GDP, but the point of mismatch and the is this: can we feel the same with the people being proactive and people being aggressive in economic productivity? That is a way outside the ambit of KRA. That is outside, actually, away out the ambit of the executive. The challenge here is, as far as KRA is concerned, as their mandate, constitutional and statutory mandate, KRA is doing a power to invent and to adjust the operation in this new normal. Yes, Simba?
Pretty much. All right, gentlemen, let's move on to the next issue this morning. Now, CBK now to determine bank dividend payouts. Now, in a move that looks to make sure that lenders safeguard the liquidity during the COVID-19 pandemic, banks now have to seek approval from the central bank before paying out dividends in the current financial year in a raft of new rules. Now, this coming days after the Kenya Bankers Association report indicating that the banking industry has enough basis to weather the COVID-19 storm. Now, in a story covered by Business Daily, some bank CEOs have revealed under anonymity that banks pushing to pay dividends will have to get approval from CBK on the size of payouts upon justification for purpose to pay the dividends. Now, Governor Patrick Njoroge introduced the capital measuring process in November 2016, requiring banks to identify, measure and monitor risks and use this as a basis for allocating their funds. George, quite controversial. Now, is this a necessary move from the CBK coming just a week after KBA is telling us, well, yes, they are hit. We've seen how they are hit. We've seen the reduced margins in profitability, but they are well anchored to ride the COVID-19 pandemic. Is this a necessary move from CBK?
In my opinion, I think CBK is trying to be careful, and CBK is trying to maintain the banking sector in a way that it can weather this storm.
George, just to come in, yes, the CBK is trying to be careful, but is that not a mandate that we should leave from the banks? I mean, we have seen some of them cancel their dividends.
We should leave it to the bank. I think, let me put it this way, Simba. The top tier banks, I know of Equity, which came out at the beginning of this pandemic, say that they're not going to pay their dividends this year, just to ensure that they have adequate cash ratios to weather this storm. I'm not worried about the tier 1 banks, but come to tier 2 and tier 3. Remember, we've had problems with tier 2 and tier 3 that have had serious cash challenges that made two of the tier 3 banks go under. I think CBK is just trying to be proactive to ensure that the banking sector is, one, stable, and two, it can be able to weather this storm. Just take you through some of the metrics for some of these top banks. Remember, Cooperative Bank reported a decline in their profitability by 3.6%. Absa Bank reported a decline in profitability by a whooping 82%, and KCB reported a 40% decline in their profitability. If you look at this vis-a-vis the previous year's performance, then you see that this pandemic has hit the banking sector very heavily. And therefore, Something else that I want to mention is that we are not yet sure when this pandemic will end, and therefore every prudent banker or every prudent business must have adequate cash ratios to be able to cushion them between now and the next 2 years. If you are to pay your dividends, then meaning you are pushing the cash that you have to your shareholders. This is the time that you want to consolidate the resources that you have, so that you are able to maintain your business in the next 1 or 2 years. The other aspect that I know central bank is looking at, some of these counters, the shares are held by foreign investors, meaning if you are to pay dividend, then you will require FX in terms of dollars to be able to pay these dividends. If you look at our Kenya shilling exchange rate, it's already quite high, meaning central bank is trying to limit the demand of dollars so that our shilling doesn't deteriorate or doesn't depreciate further. So I think on this one, I agree with central bank 100%. Tier 1 banks, I'm not worried, but tier 2 and tier 3 banks, I think there's some level of regulation that they must be given to be able to maintain their operations between now and the next 24 months.
Pretty much. All right. But just, George, before I let you go and prop in Ogwang on this as well, I'm still with you on that decision that this is just a precinct of the bank's boards just to decide whether we're going to pay out a dividend or not. I mean, even as we start this morning, we've seen that the bigger banks have provided 31 billion for non-performing loans. I mean, that's in terms of, yes, the non-performing loans. Shouldn't we just leave that out to the market to figure?
I think central bank has a mandate to regulate commercial banks. That is the mandate. And if they were to come in and say that for this year banks are not going to pay their dividend, so be it. Remember, we have seen banks providing up to 360 billion in NPLs just for the second and the third quarter. We don't know how it's going to look like in quarter 4. And it might go even higher. And if that happens, there will be in the banking industry. I told you that I'm not worried about the tier 1 banks, but tier 2 and tier 3 banks, I think the central bank must really look at them very closely so that they're able to sustain their operations between 4 months. And remember, banks are what we call capital in. Meaning they need serious cash resources to be able to maintain their operations on a day-to-day basis. The moment a bank has liquidity challenges, then there's a big problem not only for the bank, but the entire economy at large. Remember when Chase went under? Remember when Imperial Bank went under? The economic effect, the ripple economic effect that we had in the economy. I think that is what central bank is trying to cushion the entire economy about, so that we don't have to Chase Bank or what happened to Imperial Bank the previous 2 years.
Pretty much. All right, Ogwang, now this is just coming a couple of days after KBA, the Kenya Bankers Association, is telling you, no, we are not worried. I mean, if you look at the banking industry, they're well covered to ride the COVID-19 storm. But then a couple of days later, CBK is here telling you, before you pay your dividends, you come to us, we look at your books and then give you that green light. Therefore, if you cannot or not pay your dividends, that's there. Are these two statements or situations that pretty much give you a contrasting picture of what is going on in the banking industry?
Simba, I wanted us just to get a little understanding of what caused this regulation to come in place. This is not a current regulation. This regulation was proposed 2016. And so in order for us to understand the operationalization of this regulation, then we need to go back and see what was the state of affairs in the banking industry in 2016. And I like what George has mentioned. This one was to cushion the arbitrary paying of dividends. Now get this, my brother. Dividend payment is not a good suggestion. Dividend payment is not what the board does out of the goodness of their heart. Dividend payment is a right to a shareholder. So you cannot deny that shareholder enjoyment of that right, not on any written law. And that is why there is equally that what it's called the veil, the ownership veil in corporate law. What CBK is operating and it's moving, it's only that out of us being in a situation of coincidence. It's purely coincidence. But these suggestions were put in place in 2016 so that directors would not arbitrarily pay out dividends. Because the reason why Chase Bank went under was because of the arbitrary payment of dividends to directors, whereby a cross-section of the shareholders got the lion's share. When they were paid, the bank couldn't actually have liquidity to run. What the CBK through this operationalization is trying to do, and actually in their advice, it came from a prudential notice that was written, that having seen one bank has gone under and this other bank has gone under, what can we do? The challenge that we have with entrepreneurship and business landscape in the African continent, and by extension in Kenya, is that we are never honest. And so in regarding and in trying to manage that mismatch, in as much as we are concerned, let me ask you, the banking infrastructure, the banking system in Kenya today is not affected one bit by this COVID pandemic. Because let me ask you, every person that has money has that money in a bank account. When people actually get money from corruption, where do they stash all this money? In bank accounts. So guess what? No sooner do you deposit that money that it ceases from being your money. It's called banks' money. So what banks are actually trying to do is banks are just trying to appeal, and they're trying to appease to our woshe that we can pity them. But the truth is, the reason why we have this regulation was because of what banks did, what in line of flouting corporate governance measures and regulations that they cannot regulate themselves because of greed. How is it that one person, one shareholder, made Imperial Bank fall? That is what CBK is trying to mitigate. That is what CBK is trying to cushion. So moving forward, banks will still have a good running. All this money that we're changing hands, where are they? In banks, of course. So banks, if every bank, for some strange reason, is trying to say, us guys, we're not going to be profitable this year. Did Family Bank transact from the moon? They didn't transact from the moon. So which means this money is here. These people are just not being prudential. Some of these people are just being honest. We are reporting. But in order for us to curb what happened in 2014, 2015, 2016, we need this regulation. Yes, Simba.
All right, gentlemen, let's move on to the next issue this morning. When our economists have predicted a persistent pressure on the shilling against the US dollar for the remainder of the year, which will likely keep the cost of imports high. Now, the shilling has traded at above 108 units against the greenback since August 6th, and analysts now seem to think that it will likely maintain this level towards the end of the year. Now, the view is that the country's heavy reliance on less stable forms of external financing, such as diaspora remittances for foreign exchange reserves, presents a major risk to the shilling. Now, data from the Central Bank of Kenya also indicates that FDIs, seen as a relatively stable forex source, has been affected by the pandemic, remaining low at just about $1.3 billion annually, which represents a 1.4% of our GDP as a gross domestic product. Now, tourist earnings for the year also dropped heavily as a result of the restrictions occasioned by the pandemic, spelling further doom to what has been a reliable source of income for the country. Now, George, is this trend against the dollar going to be sustained throughout the year, as other analysts predict?
I don't think there's been a lot of pressure on the Kenya shilling between the month of July and now August. But in my estimation or in my projections, I think it will ease as we go into the month of September, October, and even towards the end of the year. Remember, in August we had the lowest, our lowest forex reserves or our lowest FX reserves at CBK at 9.25 billion USD, which was the lowest in the last 6 months, just covering around 5.6 months of import cover. And this was brought about by decrease in our exports. Remember, earlier in the year, we couldn't export our flowers. We had quite some exports in tea, but that also went.
All right, George. Yes, you can get us now. You sort of had a technical hitch from your end.
Are you getting me now?
Yes, we can get you.
I was saying that our FX reserves was at the lowest in the last 6 months at 9.25 billion. 6 months cover import, and as I was telling you that between the month of April and the month of July, that is both horticultural export, that is the flower industry. This sector went down. Our tourism sector, which is one of our biggest, completely down. I think it went down by over 85%. The only thing that probably was still working for us was our remittances from our colleagues who are. Also, FDI went down. In fact, it went negative because some of the investors that we had in the country away with the activity at the NSE. So with this, there was very heavy demand for USD, if you call it, and that has put the pressure on the Kenya shilling. And then, as we try to open the economy, there is a very heavy pressure on for USD. That is, we opened the second-hand clothing industry. Remember, that pushes the pressure on the Kenya shilling. Demand for dollars increases. To be the case between now and the end of September. But I think after September, go into October, November, probably our exports will start increasing, and that will ease the pressure on Kenya shilling. Again, there's something else that is working. Our current account deficit is at 5.2. It has come down from currently, meaning we are not bad off when you look at our yet that the pressure will be there between now and the end of September. But come October, November, the going down. Probably Kenya shilling might go up to 110, 111, 112 the month of October as we go into November.
All right. Now, Ogwang, if you may allow me, let's move on into the next issue. And I want to pick you first on that issue that we have this morning on NSE half-year results. Now, meanwhile, the Nairobi Securities Exchange has reported that its net profit for the first half of the year more than quadrupled to 110.6 million shillings. Now, this was against the backdrop of a 1% dip in its revenue to 292.3 million shillings. Now, the NSE's board has attributed the profit growth to a cost optimization strategy and focus on increasing income from non-core revenue streams to cushion the business from the revenue erosion risk caused by the COVID-19 pandemic. Now, the NSE board says it expects economic and market performance in the second half of the year to remain stable, driven by prospects of a gradual economic recovery, effectiveness of the government's stimulus program, as well as efficiencies in containing the COVID-19 pandemic, both in Kenya and across global markets. Now, the board is also working with key market players to roll out securities, lending, borrowing in the fourth quarter of 2020 in an effort to boost liquidity in the market. Now, the question is going to be, Ogwang, I don't know where NSE is getting its positive results from, going by just how the blue chip companies have been complaining about the effects of the COVID-19 pandemic. Do you expect that probably, now we're going to talk about the full year results, that's when we're going to see a bigger effect on the bourse just because of the COVID-19, as a result of the COVID-19 pandemic?
Actually, I had mentioned that we have a lot of inconsistency. At one extreme end, people are complaining that, hey, you guys, we are having a bad going through the hardest of time. At another extreme, why? How is it that your shares and your performance are looking upward? When you're transacting at the marketplace, you are out of inconsistencies. Let me tell you, the economy by value, in whichever space we look at it, what exchange is telling us is that they have been creating value, that value proposition, and that value proposition is actually being very much to people with long-term appetite of people would want is as at now, and actually into their optimization strategy, they are looking. One of the ways, and this is can actually be a forerunner to competitive. Link at when get
Yes, Ogwang, let me bring in George, because I also seem to have a technical issue with you. You keep on breaking as we adjust that from this end. Now, George, yes, profits more than a quadrupled. What's your feeling about that?
I think when you look at perspective, one is their financials. NSE is an incorporated company on its own right, is it? And the capital, or rather team of shares. On one hand, I think NSE has done well. I think this is the poorest performance in the last 3 years in terms of trading or in terms of activity at the NSE. The counters are not doing very some counters have even pulled out of have been pulled down of the NSE. Remember the company that pulled down the other day. And if you look at most of the counters, except the banking counters that may PL and Safaricom, you cannot have much right home about as a trading floor. But again, when you look at it, national performance, then you can see that between 2019 and 2020, their performance has increased. Profitability, that's the million in 10 was attributed to look at their expenses that 39 million to 237 million in 2020, out to 30% decline in their ad. In terms of efficiency, they have done very well in trying to manage their cost, and that should be maintained. But if you look at their common, which is promoting activity at the Nairobi bourse, they have not done very well compared to what we used to be previous. I think in 2005, 6, 7, and 8. So I think we look in those perspectives, Elijah.
Pretty much. All right, Ogwang, let me get back to you quickly at that. You say, it's not that bad as everybody keeps on saying. Why do you have that sentiment?
Because numbers never lie. Positions might lie, variations of environmental factors might lie, but numbers and reporting, if at all those reporting is actually founded on integrity, reputation, and good governance, numbers don't lie. And as at now, in as much as George has mentioned a very dire state of events with some of these trading, the thing still remains certain. Do we have, do we take their reporting to be actually founded on integrity and good corporate governance? And to that extent, I can actually tell you, well, they are actually reporting that they have quadrupled. Quadruple means 4 times, right? Regardless of the counters that have shut, the remaining counters equally ought to shut. But guess what? They are long-term investment appetite. There are people who are looking at our markets 20 years down the line. There are people who are looking at our markets 10, 15 years down the line. And those people that are actually interested with the market performance 10, 15 years down the line, they are preoccupied with the scenario and the situations around COVID. The challenge that we need to do with growing entrepreneurship and growing business practice in Kenya is we need to look long term. We need to look at, regardless of state of affairs as at now, the trajectory that our brand and our products are taking, are they trajectories that can actually translate in long term and can actually give us much more competitive? What I'm telling us is in the country as at now, in as much as we have this dire affairs with COVID-19, what is actually given and giving to entrepreneurs is this is the right time to invest. This is the right time to actually jump in whichever market space an individual is operating at, because we can be productive. There are people raking in cash. Safaricom is raking in cash. Why? By merely adjusting and innovating so that regardless around it, they don't come pity or they don't come to the masses of the market. What we need in our spaces and in our market is to be resilient and to create that resilience in our brands and in our products. COVID is just a glitch, it will end. But our markets, are they here to stay? And if need be, then we might equally need to reinvent our products, reinvent our service delivery, reinvent value proposition. What are we transacting on? Is it transaction on value? That value that can actually be divested, value that can actually be diversified upon? That is what I think, in my honest opinion, we need to do. And there are people who are looking at the counters that are transacting at their bows, that they are actually alive to redefining value. Markets are purely driven by value, regardless of the sector.
Pretty much. All right. Now, George, I just need you to take 30 seconds as we clear this conversation this morning. Do we have to wait until the end of the year for us to say, well, then it makes sense for us to talk about profits right now, or we say they are doing good regardless?
I think the way I look at this year is it's been a challenging year, so to speak, and I think companies are trying to emerge from economic impact of COVID in Q1 and Q2. I'm looking at Q3 and Q4 being slightly better than Q1 and Q2, and therefore I foresee NSE starting to have quite some activity in Q3 and Q4. So in as much as we've taken the hit from COVID-19, but I think things are not looking that bad, especially for the Kenyan economy. And I want to say this as I close, that the Kenyan economy is a resilient economy. I'm certain that we are going to rise out from this. And you start seeing some of these counters recording quite some activity as you go into Q4 and the Q1 of next year.
Pretty much. George Munga, Managing Partner, AMG Kenya, and Ogwanga Omuga, Principal, Institute of Intangible Resource Awareness. Thank you very much for gracing our show this morning. You are still watching Metropole Television. That is our show for this morning. But guess what? Some of these issues are going to take center stage as we continue with the week. And should we feel the need to call them back, you know what? We should give them a ring so they come in and weigh on some of these issues. Good morning. My name is Simba Elijah Charles Kiag.